Well, howdy there, mates. Welcome into the reaction channel. Today I'm reacting to Bloomberg, so I need to speak with my British accent today. This one, that's probably so bad. That's probably so bad. Please forgive me, okay? We're reacting to two Bloomberg videos from here today, okay? First one up here. I want to hear, why are tech stocks going to crash? So we're going to listen to this gentleman. What does he have to say in regards to this one? But this is a video I'm actually looking super forward to watching and reacting to this one with you guys, because this is a way different perspective than you'll usually hear out there. Because everybody's talking about the yield curve, and look at how inverted the 2 and 10 are, and this is going to have a massive recession. This is a massive recession indicator. And this gentleman says yield curve isn't a great recession indicator. Okay, this shall be very interesting. I always love to hear like some sort of very different view than like anybody has, and just try to see, do they have something there, or is this just a bunch of baloney? So appreciate everybody joining me as always. Thanks so much, folks. Thanks for being subscribed to the channel. New all-time high subscribers, 31,100 plus subscribers on the channel now. Appreciate y'all, and let's get into this.
The advisors sounding the alarm and writing this. Given the extreme market concentration in tech-related companies, we remain steadfast in not chasing after such investments. We view the continued dominance of this narrow leadership as unsustainable. Dan Suzuki joins us now for more. Dan, wonderful to catch up with you, sir. I remember when it was unsustainable back in February, back in January, and it continued. Why is it unsustainable now?
Yeah, well, Jonathan, thanks for having me. And to be fair, I mean, you introed me, a few minutes ago saying I'm ringing the alarm. Clearly, the market and investors have been hitting the snooze button on that alarm. But I do think at this point, we are close to an inflection point. Either, you don't have to be a rocket scientist here, either profits growth is in the process of bottoming and it's going to start to improve, or earnings growth is going to weaken further here, due to, disinflationary risks and the impact on margins. But either way, earnings go, I think tech is going to be a loser, because if earnings reaccelerate here, why would you pay 40 or 50 times earnings when you can get companies with superior earnings growth that are cyclical at a fraction of the cost? Think, energy, financials.
Oh, hold your horses. Hold your horses just a moment, okay? Let's be very clear. If somebody's paying 40, 50 times earnings, like he just said, okay, they're doing that because they are of the belief that those companies' earnings are going to grow dramatically over the coming years, and obviously far outstripping the market, maybe at a 3x, 4x, 5x type, let's call it growth rate, right? If somebody's buying a Tesla here today at whatever Tesla's trading at, it's because they believe earnings are going to grow substantially faster than the rest of the market. Same thing if you're buying Amazon today, right? So yeah, I don't think anybody out there is buying any stock that's of those valuations unless they are convinced that those companies' earnings are going to grow substantially faster than whatever other companies you pretty much have to pick from out there.
Small caps, value names, all trade at super cheap valuations, have much more cyclicality, and therefore benefit from a better growth environment. Conversely, if things get worse, you're going to question, paying that type of multiple for companies that don't have earnings growth today, when you can buy companies that actually have earnings growth, the more defensive, less cyclical parts of the economy.
So let's talk about where valuations are better in the cyclical parts of the economy that you mentioned first. What's the argument to buy cyclicality right now when people are talking about the prospect of recession constantly being around the corner?
Well, as you said, Jonathan, people have been talking about a recession for a long time. Clearly, the economy doesn't collapse overnight. And so there's a lot of reasons to believe the economy, any potential recession is still a ways off, with the household and the consumer still as resilient as it is. Now, I think that there's a big debate to be had here, because for every positive green shoot that we've had over the last few months, you've had a very, very important counterpoint, in the leading and important, more cyclical parts of the economy, whether it's ISM hitting new lows, it's increasing distress and delinquencies within the credit markets. It's, a lot of the earnings season, some of the commentary from the companies that have the most exposure to the labor market are saying that the government data is lagging the trends that they're actually seeing in their labor market. So for all these things, there's still some caution out there to be warranted. But if we are in the process of bottoming, and we have this conversation 6 months from now, and earnings growth is reaccelerating, then clearly, there's probably a lot of upside to earnings for industrials, financials, energy, and tech for that matter. You're just paying a lot for tech when you can get better earnings growth elsewhere for cheaper.
So Dan, tell me, what are you advocating for clients right now? What are you advocating for?
Well, Jonathan, I think the most important thing right now, and you sort of, introed it with that quote. Basically, we tell our clients all the time that returns are greatest when capital is scarce. I think what's more tantamount today is the inverse of that, which is that risks are greatest where capital is concentrated and expensive. I don't think there's any debate out there, whether you're a bull or a bear, what part of the market that is. And so I don't think it makes sense to chase that part of the market. I think you're better served elsewhere. And if you look elsewhere, everything else is trading. You'd be hard pressed to find an area of the market that's trading above 13 times, 14 times relative to the S&P 500 at almost 20 times. And so I think you can basically go buy anything out there as long as it's not that concentrated part of the market. If you're worried about growth slowing down, own the higher quality, less cyclical names like healthcare staples and utilities. If you think that we're in the process of bottoming and things are going to get a lot better, again, value, small caps, financials, industrials, energy, all that stuff is going to do incredibly well.
So, the main issue I see with kind of that gentleman's point of view there is, I just got done watching Fast Money about an hour ago or so. And guess what? 3 of the traders on there have been arguing for the longest time about how you shouldn't be buying tech stocks, you shouldn't really own tech stocks. If you believe the rally is sustainable, then you need to be rotating into. This is a view I hear out there constantly. And so it just makes me think, gosh, man, like how many people on the street really have this view? Because I can tell you, it's a large number, folks. And I mean a really large number. Every time I watch on CNBC, they're telling you, don't buy the tech stocks, don't buy the tech stocks. And you just got to think, like, all these people saying, don't buy tech. I mean, heck, even we reacted to what Tom Lee last night on the channel. Even he was talking about potentially tech stocks pulling down. And it's just if everybody has the same view, I don't know, man. Just many times in the market, the opposite happens. So maybe everybody's going to be correct and tech will be weak and there'll be other strengths in the market. But I don't know, man. It's just like usually it goes completely opposite. It's like going into this year, everybody and their grandma was bearish. And what do we have? One of the best first halves of the year in the market we've ever seen in history. Like, it's absolutely extraordinary, especially when it comes to NASDAQ. I mean, that was ridiculous. I think it was the best or the second best year in the history of the NASDAQ, I believe, for the first 6 months. And everybody was doomsday going into this year. Many times the opposite happens that everybody's anticipating, right? Most people went into 2022 actually really bullish, and gosh, we know what happened in 2022, right? Alrighty, next video up here. This one I'm looking so forward to watching. Yield curve isn't a great recession indicator. This should be intriguing.
Ask you about the overriding trend that Eric was just outlining. We don't have this avalanche into fixed income ETFs that we've been seeing for pretty much the entire year so far. Why do you think that is?
So I think there's a couple of things. The primary one being the Treasury's issuing about 299 billion bills a week. Billion bills a week, gross, about 70 billion net at 5.5%. So you think about it, you functionally can sit in cash at 5.5%, or you go to the long end of the yield curve and get less than 4%, and you got to take, very long interest rate, very long duration, very long interest rate sensitivity. I mean, these cash levels are pretty high, and so people say, gosh, I'll take that. We'll talk about, can you get yield in fixed income? You can. But boy, if you carry at...
Okay, I'll be honest, guys. This guy just reminded me of something extremely, extremely important, and sometimes we can forget this in this market currently, right? Especially coming off of that video we just watched of the guy, negative, obviously, on tech stocks and whatnot. This guy just reminded me of how much money is out there right now in savings accounts, in treasuries right now. It's ridiculous. And people are earning 4 or 5% on that money right now, just sitting on it. And at some point in time, they're not going to earn that 4 to 5% anymore. Sooner or later, that will end, right? And people are going to have to be faced with the reality of, where do I put that money? Do I keep it in here if it starts earning me less, or do I move that money into the market and seize opportunities in the stock market at that particular time? So that's where things get very, very interesting right now, is all that money that's out there that at some point, a portion of it, we don't know how much, but a portion of it's going to come into the market and add more fuel to the fire. And so, intriguing times in the markets, and that's why it's one of the more confusing times for investors to kind of be bearish and bullish
5.5, or you build a portfolio today that gets you some income, and then go in. There's a good chunk of the equity market that's below the average multiple. So, so if you're filling out your investment portfolio card today, and you said, "Gosh, what am I going to do? I'll carry high, and then I'll buy some equities that have some upside," and that works pretty well.
And there's a lot of great value stocks and dividend stocks that are real significant discounts right now in this market. I mean, there's some growth stocks out there that are opportunities as well. PayPal's one that definitely comes to mind. But dividend stocks and value stocks, man, there's a lot of opportunities out there right now. And the reason being is just a lot of people are like, why do I want to risk my money in one of these dividend stocks that pays me a 4 or 5% yield when I can have my money over here earning me risk-free in a savings account 4 or 5%, or in a treasury 4 or 5%? Like, why would I do that? And so, once again, at some point in time, that money's going to come back in.
I do love that you talk about equities, even as a bond guy, but I want to stick to the bonds right now, because if you look at the bond market in ETFs broken down by maturity, it caught my eye that for the past 2 months, you've seen a lot of money come out of short duration funds. So those maturing in 1 year to 3 years. But then you take a look at ultra short, and it's still holding on to all of those assets that it's taken in so far this year. What is it about the short space that people are getting out of right now?
So first of all, you've got an inverted curve, and today, functionally sitting in cash or cash-like, I know I think I said it on the show we did the other day, that you can own commercial paper, that's 6-month, 9-month commercial paper, and clip over 6 yield, which is pretty incredible. As you think about, if you're, gosh, I could do that, maybe I'll own parts of the high-yield market or parts of EM and get higher numbers, 8, 9, 10. And so to sit in someone with an inverted curve, to sit in some of these areas that are not paying you a lot, doesn't make a lot of sense. So I'm sure there's some of that dynamic at play today. You look at. So go ahead. No,
well, Rick, you mentioned the inverted curve, and I've just been kind of obsessing over this for the last few hours, and of course this year we've all been watching that. Now, the reason I've been thinking about it, Ed Yardeni thinks he has an explanation for the incredible inversion we've seen. I mean, 3 months, 10-year, over 150 basis points, right? And everyone's saying, does that mean a recession's coming, or what is it signaling? Because the real economy data that we have looks very good. So Yardeni says maybe the inversion of the yield curve just means that inflation is coming down at a rapid pace and not necessarily flagging a recession as it has the last 7 times. What's your take on that debate?
So I think the inversion of the yield curve is a good indicator of recession, but it's been wrong. I think it's like it predicted 9 of the last 3 recessions. I don't think it's I don't think it is a great indicator. And you think about what's happening today. You used to have an economy that was very interest rate sensitive. The economy today is not interest rate sensitive. The companies that borrow for CapEx, the companies that spend on CapEx today, you think about the big tech companies that are spending on AI, or the Googles, Microsoft, the Apples, they don't really borrow. They use free cash flow. People have already locked in their mortgages at 3.5. I think it is.
Okay, so before we go further, because these are actually some really important points here, and that's why I want to rewind this, make sure we're getting everything in here. He makes an argument that the economy is not very interest rate sensitive like it might have been in the past. I'll push back against that. I mean, at the end of the day, it absolutely is, especially if you're doing any big ticket purchases, whether it could be a home, a car, a boat, an ATV, like anything, right? So I'll push back against that a little bit. Obviously, if you're a company that holds significant amounts of debt, you need to refinance the debt, do anything in relation to that. When you're in a higher interest rate environment, it's very detrimental to you. And that's one of the worries around stocks like AT&T, Verizon right now, these huge debt loads. And what does that mean for these companies in a high interest rate environment that they haven't had to deal with in 15 plus years?
Great indicator. And you think about what's happening today. You used to have an economy that was very interest rate sensitive. The economy today is not interest rate sensitive. The companies that borrow for CapEx, the companies that spend on CapEx today, you think about the big tech companies that are spending on AI, or the Googles, Microsoft, the Apples, they don't really borrow. They use free cash flow. People have already locked in their mortgages at 3.5. So you don't have interest rate sensitivity there. The economy is just not, and you think about all the hiring in the economy, healthcare, education, these are not interest sensitive dynamics. So what happens is the Fed lifts the front end of the yield curve up, and you don't create that much of an impact. But like you say, inflation is coming down. So you create this inversion in an economy that's actually resistant to or less sensitive to interest rate hikes. And so it's not, I would argue, it's not a good indicator at all.
Yeah, so my little pushback there is, he brings up 2 of the greatest balance sheet companies literally in the world. And there's not very many of those sorts of companies. The Googles and the Microsofts, those are probably two of the best balance sheet companies. Certainly in Google's situation, you can make an argument that it might be the best balance sheet in all of the stock market, right? So just keep in mind, for every one of those, there's 10, 20, 30 companies out there that have pretty poor balance sheets on like a Google McDougal.
Speaking of indicators, I read an interview with you from a couple of weeks ago. You talked about you pay a lot less attention to surveys, where it's people's opinions about what's going to happen. You'd much rather read earnings reports. And so we have a lot of earnings coming up. I'm just curious what you're looking for in the next couple of weeks there.
Yeah, I mean, by the way, I find some of these surveys where they poll 500 people, they're similar to election polls. Like, people talk about what they feel like, and then actually they could be in a bad mood, but they keep spending. So I don't find these surveys terribly robust. And it just swings like everything else with Sun. What am I looking for? I'm looking for top line. I'm looking for what are revenues on a top line basis in an economy that's operating pretty well. But I'm also looking at, there's real dispersion in some of these companies today. So you look at some of the retailers, apparel, electronics, furniture that have been struggling a bit. But gosh, and then you look at travel, it's operating really, really well. The airlines, the cruise lines, the hotels. So I'm looking at dispersion. And then, quite frankly, one of the things that around, tech drives so much today is what's happening with search, what's happening with advertising spend. And those are going to be pretty important numbers to look at today. But I'm pretty keyed in on top line revenue. And our companies able to keep their margins at a reasonably stable level, given some of the input costs have gone up.
Well, Rick, it's going to be a really interesting week for you because I believe we have 165 companies in the S&P 500 reporting this week. We don't have too much time with you before the break. You're sticking with us. But before we go to commercial, I do want to ask about your thoughts on high yield credit, because it's not lost on me that junk has been really performing well this year. Then you take a look at the flows. You've had nearly $6 billion leave from junk ETFs, whereas fixed income ETFs overall have taken in over $100 billion. Why does no one want to buy into this junk rally?
So a couple of things. One, I mean, you can get yield in a bunch of other places. We talked about EM. We talked about some of the quality yields you can get that are pretty attractive today. And quite frankly, part of high yield today, if you're doing it in a passive way, half the index trades at tighter than 300 spread and half trades above 800. So you're getting a lot of tight stuff, and you're getting a lot of what I would argue companies that are under some stress. Part of why, we're doing this in our ETF is being selective around the names that are actually paying you for the risk. That makes a lot of sense. And then the other side of it is, if you're using beta in your portfolio, equities are doing a whole lot for you in terms of using that beta bucket. If you can get income in other ways, in safer ways, then, that's what, as you're saying, if you fill out your investment portfolio card, a lot of safe carry and then get the beta that's really working for you has made a ton of sense.
Yeah, so basically, to kind of sum up his strategy there, try to take as little risk as possible, have your money in some of these places you can get 4 or 5% easy yield, right? And then high beta, basically meaning more toward like tech stocks, growth stocks, things that are very volatile, right? And obviously many of those stocks have been performing tremendous, as we know, right? Look at NVIDIA, look at Tesla, look at Meta, look at some of these stocks. So interesting thoughts overall. I appreciate his views kind of even on the yield curve, because yield curve, it's one of those things that eventually it catches up to you, but the timing is very uncertain. And that's the thing with the yield curve, is it's like, well, yield curve inverts. Are we talking about a recession for sure comes? If it does, is it 6 months, 12 months, 18 months? That's a big debate. So appreciate everybody joining me as always. Thanks so much for being here, folks. Thanks for being subscribed. New all-time high subscribers in the history of the channel. I appreciate y'all. If you're looking to apply to join my private group, check out the pinned comment down there. You can fill out an application. We can see if you're a good fit. Much love as always, and have a great day.